We often find ourselves transfixed by the endless loop of global market headlines. A sudden conflict, an economic downturn, or an unexpected policy shift sends waves of panic through the financial world. But history teaches us a profound lesson. True wealth creation belongs to those who look past the immediate chaos and focus entirely on the long horizon. There's an old, unwavering rule in macroeconomics. Good prices and good news almost never arrive together. When headlines are filled with optimism, asset valuations soar, leaving very little room for future growth. The real window of opportunity opens when the news seems discouraging. That is when premium assets trade at a deep discount, offering a major launchpad for compounding. Consider the sheer power of consistently outperforming the baseline market index by just 3 to 4%. Over a long investment horizon, that slight mathematical edge, known as alpha, fundamentally transforms the end result. A standard market return can steadily multiply your capital, but adding a consistent premium alpha can actually double that final fortune. That is the ultimate magic of compounding. To capture this premium growth, an investor must avoid missing the forest for the trees. Short-term market trading is a game of noise and distraction. Instead, the focus must shift entirely toward massive structural economic megatrends. By identifying sectors with a clear runway of growth for the next decade, short-term market corrections cease to be a threat. They become a massive strategic advantage. Currently, a major structural shift is occurring within global commodities, particularly in non-ferrous and precious metals. While general market indices have experienced sluggish earnings growth over recent quarters, the metals and mining segment has quietly delivered strong double-digit corporate earnings growth. The underlying fundamentals reveal a powerful long-term cycle in the making. 3 critical filters define a highly profitable commodity cycle. First, the asset must already be in a supply deficit. Second, the global demand must be highly inelastic, meaning consumption remains strong even as prices rise. Finally, expanding the supply must be incredibly difficult and capital-intensive. When these 3 factors align, prices remain highly resilient. Investing directly in the raw commodity is one approach, but targeting the lowest-cost mining operations offers an amplified return. As metal prices increase, a mining company's operational revenue expands, but its fixed costs remain stable. This causes net profits to multiply at a much faster rate than the raw material price itself, making top-tier miners highly resilient during a prolonged bullish cycle. A similar long-term structural logic applies to essential infrastructure, such as premium healthcare and specialized hospital networks. As a developing nation transitions into a high-growth, middle-income economy, per capita spending on advanced healthcare naturally scales. However, smart capital allocation requires balancing this massive structural demand against current market valuations to ensure a favorable risk-reward ratio. Another undeniable economic transition is unfolding in the defense sector. Historically viewed purely as an administrative expense, defense spending has transformed into a high-tech domestic manufacturing powerhouse. Driven by global geopolitical shifts, nations are aggressively moving away from foreign imports towards self-reliance, unlocking massive long-term order books for internal industries. Conversely, sectors that dominated the past decade are facing structural headwinds. Consider traditional information technology services. Even before the dawn of advanced artificial intelligence, global tech service growth had moderated into single digits. Now, with rapid automation and AI platforms threatening to automate routine coding, the traditional labor arbitrage model faces severe disruption rather than a growth acceleration. This brings us to a beautiful economic paradox. The more digital, virtual, and AI-driven our world becomes, the more physical infrastructure it requires. Artificial intelligence cannot exist in a vacuum. It demands immense physical data centers, complex power grids, massive transformers, and specialized high-voltage transmission lines. This creates a highly profitable pick-and-shovel investment landscape. During a historic gold rush, the individual prospectors digging in the dirt rarely secure the largest fortunes. The definitive winner is often the entrepreneur who controls the supply of picks and shovels. Today, while tech giants compete fiercely to see whose AI model will reign supreme, the smartest move is to invest in the critical building blocks they all require: the power, the infrastructure, and the raw industrial metals. Navigating these sectors requires a disciplined valuation framework, specifically focusing on the relationship between earnings growth and price-to-earnings growth ratios. When a highly productive sector remains structurally sound, yet sits completely underowned and overlooked by mainstream global funds, the risk-reward ratio becomes incredibly attractive for long-term capital deployment. On the global stage, a shifting currency dynamic acts as a powerful catalyst. When a dominant reserve currency, like the US dollar, experiences structural weakening, institutional capital naturally shifts toward high-growth, emerging economies. Markets trading at extreme valuations face stagnation, while regions backed by strong domestic consumption and robust manufacturing infrastructure present a superior risk-reward proposition. We are witnessing a historic, generational economic expansion. Volatility will inevitably emerge, but temporary market turbulence is not an obstacle. It is a mechanism that resets valuations for disciplined buyers. By aligning your capital with physical infrastructure, structural energy demands, underowned commodities, and domestic manufacturing, you position yourself perfectly on the right side of economic history.